Welcome to The Explainer. Today, we're putting Lowe's Q1 2026 financials through the absolute ultimate stress test. We're going to step into the shoes of expert investment analysts and run this massive home improvement retailer right through the legendary frameworks of the greatest investors of all time. Let's get into it.
So the big question we got to ask is, would titans like Warren Buffett, Peter Lynch, or Benjamin Graham actually touch the stock at its current $213 price tag? It's one thing to just stare at a stock chart, right? But it's an entirely different beast to actually dismantle a company's balance sheet using the exact criteria of billionaires. Here's our game plan. We've got a rigorous 6-step gauntlet. We'll start with a snapshot and the Buffett lens, move to the Peter Lynch lens, then the Benjamin Graham lens. After that, we'll dive into a discounted cash flow valuation, look at some additional models, and finally bring it all together in a synthesis. All right, Section 1, Lowe's snapshot and the Buffett lens. Before we start grading, we need our baseline facts. So, Lowe's, ticker symbol LOW, is currently trading at around $213 a share. Looking at the recently reported Q1 2026 results, they raked in a massive $23.1 billion in sales and netted $1.6 billion in earnings just for the quarter alone. And with 1,759 stores making up over 196 million square feet of retail space, yeah, their physical footprint is undeniably massive. Now, it's really fascinating to see how Warren Buffett actually evaluates a company. The Oracle of Omaha doesn't just glance at net income and call it a day. He demands a strong economic moat, a durable competitive advantage. Plus, he focuses heavily on owner earnings. Basically, that's the true cash a business generates for its owners after covering the capital expenditures needed just to keep the lights on and maintain the business. So running Lowe's through the Buffett checklist. First step, moat? Yes, easily passes. It operates in a virtual duopoly in the home improvement space, it's got solid management, and a stellar return on equity. It also easily passes the consistent earnings test. They posted over $6.6 billion in net earnings in the previous full fiscal year. But the debt levels, that's something Buffett would definitely monitor closely. They're carrying over $36.7 billion in long-term debt, which is hefty, though it is somewhat mitigated by their massive $9.8 billion in operating cash flow. Which brings us to the absolutely crucial point. How much actual cash does Lowe's generate? Based on their last full fiscal year, Lowe's generated roughly $7.65 billion in approximate owner earnings. We calculate that by taking their robust $9.86 billion in operating cash flow and simply subtracting the $2.2 billion they spent on capital expenditures. For Buffett, this $7.65 billion number is the real engine of the company. Because of this massive cash generation, the strong management, and that wide moat, Buffett would likely view Lowe's as a definitive buy, assuming, of course, the price offers a sufficient margin of safety. Moving right along to Section 2, the Peter Lynch lens. Let's swap out our Buffett glasses and see what Lynch thinks. Peter Lynch famously likes to categorize companies by their growth speed, everything from slow growers to fast growers. And to do this, he relies heavily on the PG ratio. The PG ratio just divides a company's price-to-earnings ratio by its earnings growth rate. It's his way of making sure you aren't overpaying for future growth. Generally, a PG around 1 is considered fairly valued. Okay, so under Lynch's system, Lowe's is definitively a stalwart, basically a slow, steady giant. Their forward PE ratio sits at roughly 17.5, and that's based on their 2026 EPS guidance midpoint of around $12 a share. But here is the catch for Lynch. Lowe's is guiding for flat to maybe 2% comparable sales growth this year. Because that short-term growth rate is so incredibly low, dividing a 17.5 PE by a maximum 2% growth rate gives us a really high PEG ratio. Plus, without significant insider buying to signal confidence, and with heavy institutional ownership already totally baked in, Lynch would probably categorize Lowe's as a hold right now. He'd be waiting for some kind of catalyst to accelerate that growth. Next up is Section 3, the Benjamin Graham lens. Now, Benjamin Graham was Warren Buffett's mentor, and his whole philosophy is entirely built on downside protection. He famously said the secret of sound investment is 3 words: margin of safety. He really wants heavily discounted assets to protect the investor from unforeseen economic storms, and he relies on a very rigid defensive checklist to find them. Running Lowe's through Graham's defensive checklist actually yields some pretty fascinating results. Adequate size? Pass. Earning stability? Pass. Dividend record, that's an incredible pass. They paid out $674 million in cash dividends in Q1 alone. Moderate PE? Pass. But When we get to the price-to-book ratio, Lowe's hits a massive, catastrophic roadblock. It completely fails. And honestly, this brilliantly illustrates a fascinating quirk in modern finance. Graham's famous intrinsic value formula multiplies earnings per share by book value. But if you actually look at Lowe's balance sheet, they have a massive accumulated deficit of $9.88 billion. Now, hold on. This isn't because they're losing money. It's because they've spent years aggressively buying back their own stock, which practically pushes their shareholder equity into negative territory. So, because the book value is technically negative, Graham's formula mathematically fails here. The literal father of value investing would likely walk away from this stock simply because modern aggressive capital return strategies break his 1940s math. Crazy, right? All right, since Graham's formula just broke on modern balance sheet accounting, let's transition to Section 4, discounted cash flow valuation. To find the true intrinsic value of the company, we've got to project the cash the business will make into the future and discount it back to today. Because our source material gives us a Q1 snapshot, we have to make some standard industry assumptions to fill in the gaps for our model. We'll use our calculated $7.65 billion free cash flow as our base. Then, we'll assume a standard 9% discount rate, or WAC, and a modest 3% long-term terminal growth rate. This reflects their massive market saturation, but also accounts for their steady pricing power. Taking a look at the sensitivity of our assumptions, if we stick to our base case of a 9% discount rate and 3% terminal growth, the DCF spits out a fair value of around $225 per share. With the stock currently trading at $213, this suggests Lowe's is trading at a slight discount. So it actually offers a modest margin of safety for the modern value investor. Moving into Section 5, additional models. Let's look at multiples and the dividend discount model. We need to stress test that DCF output, and these two additional models give us totally different perspectives. The dividend discount model, which values a stock purely based on its future dividend payouts, paints a pretty bearish picture. Because the current yield is only around 2% based on their $1.2 quarterly payout, the dividend alone really isn't enough to justify the $213 price tag. That model gives us a value closer to $120 to $140. On the flip side, if we look at comparable multiples, applying a historical 20 times PE multiple to their $12 expected earnings points to a much more bullish $240 fair value. Okay, we've run the gauntlet. Let's wrap this up with Section 6, synthesis and final recommendation. We essentially have 5 different answers here, and the results are incredibly divided. Buffett sees a buy based on that strong moat and those owner earnings. Lynch says hold due to the stagnant short-term growth. Graham's model, well, as we saw, brigs entirely. Our DCF shows it's fairly valued around $225, and historical multiples say it's slightly undervalued at $240. So what's the ultimate takeaway? Lowe's is an absolute cash-generating machine with a wide competitive moat. They push out massive dividends and buybacks. But as an investor, you really have to accept that heavy $36.7 billion debt load, along with the reality of a currently stagnant housing market that resulted in just a 0.6% comparable sales growth in Q1. At $213, we're looking at a stock that is effectively fairly valued. The easy money has probably already been made, and right now it requires some real patience. So I'll leave you with this. Which philosophy actually matches your own investing style? Are you a Buffett, seeking a durable moat and cash flow at a fair price? Or are you a Lynch, waiting on the sidelines for the housing market to turn and growth to accelerate before you make your move? All the numbers are right there in front of us, but the lens you choose to look through, that makes all the difference.